When the taxman comes knocking, it's not really a conversation. It's a legal process with very specific rules. Understanding what powers they have, and just as importantly, where those powers end, is absolutely crucial. So let's break down the official rulebook, shall we?
It's the big question, right? It's something that can cause a whole lot of anxiety. Can they just show up at your door? Can they take your property? We're going to look at what the law actually says, from a simple request for documents all the way up to a full-blown search and seizure.
So here's our roadmap. We're going to follow the whole investigation process step by step. First, we'll see who actually has the green light to investigate. Then we'll climb the ladder, from basic info requests to on-site surveys, and finally to the most serious action, a search. We'll also cover what happens to any assets they take, and, most importantly, the rights and limits that are supposed to keep the scales balanced. Okay, so first things first, who actually gets to wield these powers? It's not just any tax official who feels like it. The law is really specific about the chain of command. The law creates this specific group called the Investigating Income Tax Authority. And as you can see, it's a hierarchy, right? It goes from the top dogs like directors general all the way down to inspectors of taxes. But here's a key detail. An inspector can't just go rogue. They need permission from a deputy commissioner. That's a clear system of oversight built right in. So, how does this whole thing usually kick off? Well, before there's any talk of a surprise visit, the process almost always starts with something much simpler, a formal, written request for information. And the law gives them a few tools for this. They can send you a written notice asking for specifics, they can legally compel you to hand over business records, or they can start digging into your income sources directly. And of course, in today's world, they can even require certain places to automatically share financial data with them. And again, this isn't a power given to just anyone. The law says these formal requests have to come from an official at the level of a deputy commissioner of taxes or higher. It's another one of those built-in checks to prevent things from getting out of hand at the lower levels. All right, so what happens if sending letters and asking for documents doesn't clear things up? Well, the next step up is an on-site visit. Legally, it's called a survey, and it is so important to understand how different this is from a full-blown search. This distinction is absolutely key. Think of a survey as basically a spot check. Officials can pop into a business, but only during normal business hours. It's designed to be way less invasive. A search, on the other hand, is much more serious. It's highly intrusive because it's based on a real suspicion that someone is actively hiding information. Two very different things. So during one of these surveys, an officer has some specific powers. They can come in, they can look at your books, and even put an official stamp on them. They can make a list, an inventory of any cash or valuables they find. They can also take your records, but only if they write down why. And they can question people under oath right then and there. But here's the line in the sand, stated right in the law. During a survey, an authority can list out your cash and valuables, sure, but they are explicitly forbidden from taking them. This really hammers home the point. A survey is for looking, not for taking. Okay, now we're getting into the heavy stuff. We're moving on to the most significant power the tax authority has, the power to search a place and actually seize assets. This is where the stakes get a whole lot higher. An action this invasive can't just happen on a whim. The law sets a really high bar, a specific threshold of proof that has to be met before a search warrant can even be issued. And the law is super specific about this. To get that search warrant, the authority has to have what's called reason to believe that a person is refusing to cooperate. Either they've already been asked for documents and didn't provide them, or there's strong evidence suggesting they would hide or even destroy them if asked. Without that specific justification, a search just isn't legal. But once a search is authorized, well, the powers become massive. Officers can enter and search pretty much anything. Buildings, cars, even boats. They can break open locks if they need to. They can search you if you're there. And, this is the critical difference from a survey, they can seize documents, cash, gold, jewelry, and other valuables. And that power extends to the digital world too. They can copy data right off your computer systems. So, the search is over, and maybe some assets have been seized. What happens next? The process doesn't just end there. There's actually a very strict, time-sensitive procedure that the authorities are legally required to follow. From the second those assets are seized, a 90-day clock starts ticking. Within that 3-month window, the deputy commissioner has to do a few things. They must give the person a chance to tell their side of the story, they have to estimate any undisclosed income, calculate the total tax bill, and then issue a formal order. All of that has to happen within 90 days. And that 90-day deadline, It's a really critical protection for the taxpayer. It's not a suggestion, it's a hard legal requirement. This makes sure that cases are processed quickly and prevents the authorities from just holding on to someone's assets forever.
Okay, so what actually happens to the money or valuables they seized? It's not like it just vanishes into a government black hole. First, it's used to pay the brand new tax bill that was just calculated from the search. Then, it's used to cover any other old tax debts you might have. And this is really important. Anything left over, any surplus, has to be returned to the person it was taken from. So, we've seen the pretty immense power that the law gives to tax authorities. But here's the thing, these powers don't exist in a vacuum. The entire system is actually designed to be a set of checks and balances.
Think of it like a scale. On one side, you've got the state's very real need to enforce tax laws. But on the other side, you have these crucial protections for the taxpayer: the right to be heard, the right to make copies of your own documents they seized, strict deadlines like that 90-day rule, and the need for a senior official to sign off at every big step. It's all designed to make sure that power is never absolute.
So in the end, the law gives us this detailed rule book for a pretty high-stakes game, right? It defines the powers of the state and the rights of the citizen. And while the framework for a fair process exists on paper, I guess the question that always remains is, how fairly is that game actually played in the real world?